right now, the global cost of a raw material that's basically essential to feeding the whole planet just doubled.
Yeah, doubled.
Yeah.
Literally overnight.
Right. And simultaneously, the biggest supplier in the entire world just locked its doors. They're refusing to sell to anyone outside their own borders.
Which is just a massive shock to the system.
Exactly. I mean, in any normal scenario, a company caught in the middle of this kind of, supply chain collapse would be issuing catastrophic profit warnings. They'd be begging Wall Street for patience.
Oh, absolutely. They'd be in full damage control mode.
But instead, ICL Group, which is a major specialty minerals and chemicals company sitting right in the crosshairs of this crisis, they just posted double-digit growth.
Yeah, it's wild. It really is a textbook example of how a completely hostile operating environment doesn't necessarily dictate like a catastrophic financial outcome.
Right.
Provided, of course, that the company has the right geographic moats and structural leverage. But you really have to read the fine print here because gravity does eventually catch up with everyone.
And that's exactly what we are going to do today on this Talk Tickers edition of our deep dive. So welcome, everyone. The mission today is simple. No fluff, just the data, the mechanics behind the data, and an actionable, opinionated bottom line on what this all means for your portfolio.
Let's get into it.
Yeah, let's jump straight into the headline numbers because at first glance, I gotta say, the top of the income statement looks like it belongs to a tech company in a massive bull market, not, a physical commodities producer navigating a literal war in its own backyard.
It really does. The top line beat was aggressive.
So revenue came in at a massive $2 billion. That is a 14% increase year over year.
Right. And
adjusted earnings per share, so the actual profit attributable to each share you own, that hit 11 cents, which is a 22% jump.
Yeah, and you have to remember, for a company that's heavily invested in physical infrastructure, mining, heavy chemical processing.
It's not cheap to run that stuff.
Exactly. So moving the top line by 14% to clear that $2 billion hurdle in a single quarter, that is a huge statement.
It really is. And adjusted EBITDA landed at $412 million. Which was up 15%.
But what you really want to zero in on is how that EBITDA translated to actual liquidity, right? Because operating cash flow reached $195 million, and free cash flow settled at $61 million.
Okay, that cash flow metric is crucial. Yeah. And honestly, it's where I want to start my pushback on these numbers.
Let's hear it.
Because look, historically, we've seen commodity companies post these massive revenue beats that completely mask underlying rot. Like you see sales go up, but inventory is piling up in warehouses, accounts receivable are stretching out for like 90 days.
Yeah, they're technically profitable on paper, but bleeding cash in reality.
Exactly. So the fact that they converted this into nearly $200 million in operating cash flow proves the money is actually hitting the bank account.
It's real money, yeah.
But I'm still, highly skeptical of the quality of this growth. 14% revenue growth in a quarter where inflation is just rampant and shipping lanes are a total disaster. I mean, are they actually growing the business, moving more physical product out the door, or are they just jacking up prices to cover their own exploding costs and, calling it growth?
Right. That is the exact right question to ask. And the short answer is, well, it's predominantly the latter. It's pricing power. But there's enough of the former to make it legitimate.
Okay, unpack that for me.
So you're looking at a classic dynamic of pricing power doing the heavy lifting here. Aviram Lahav, ICL's CFO, he actually laid this out mathematically in the sales bridge during the earnings call.
Oh, right, the sales bridge.
Yeah. Out of that 14% revenue increase, a staggering $159 million came purely from higher prices.
Wow. So they are essentially just passing the macroeconomic pain directly onto the buyer?
Exactly. I mean, when we talk about pricing power, we are talking about a company's ability to basically say to its customers, hey, our input costs went up by 20%, so your invoice is going up by 20%.
And the customer doesn't cancel the order.
Precisely. The customer still buys it. But it wasn't exclusively price. And this is where ICL really separates itself from a company that's just surfing an inflationary wave. They also drove actual volume growth in key areas.
Okay, so they did move more physical product.
They did. For instance, their potash production volumes were up 11%. They actually crossed 1.1 million metric tons for the quarter.
Let's dig into that, actually, because potash is such a massive part of their identity, and it's a completely non-negotiable input for global food production. Like, you can't just grow high-yield corn or soybeans at modern agricultural scale without potassium,
Yeah, correct.
which is what potash provides.
Right, it's fundamental.
But how exactly did they increase physical volume by 11% when they're operating in the middle of a conflict zone? Did they just discover a new mine or something?
No, it's nothing like that. This is where their operational mechanics really come into play. ICL's primary potash extraction isn't like a traditional underground mine,
Right.
like you might see in Saskatchewan with a company like Nutrien.
Right, guys going down an elevator.
Yeah, exactly.
Right.
ICL actually extracts a massive portion of its potash from the Dead Sea. They use this huge system of shallow evaporation ponds.
Oh, wow.
Yeah, so the sun does a significant amount of the heavy lifting. It concentrates the brines, and then they harvest that to extract carnallite, which is the raw material for potash.
So what drove the volume increase then?
It was equipment availability and optimized maintenance. They structurally shortened the downtime at both their Dead Sea facilities and their conventional mining operations in Suria, Spain.
So just better uptime means more throughput.
Exactly. They optimized the machinery.
Okay, so they optimized the machinery, push 1.1 million metric tons out the door, and because of the global supply crunch we mentioned, they were able to charge a massive premium. I have the number right here. The average potash price they achieved was $362 per ton. That's a 21% increase year over year.
It's massive.
So you have an 11% volume increase multiplying against a 21% price increase. That right there is the raw engine behind that $2 billion revenue print.
Precisely. It's compounding operational leverage at its finest. But, ICL isn't a pure play fertilizer company. And that is what makes their financial structure so resilient.
They have 4 distinct segments, right?
Yeah, exactly. Aside from potash, they have phosphate solutions, growing solutions, which focuses on like specialty agricultural products and industrial products.
And the industrial product segment delivered one of the most, I think, fascinating microeconomic storylines of the entire quarter.
Oh, absolutely. The bromine business.
Right. The management team noted that bromine prices hit their highest peak since the end of 2022. And I want to spend a minute here because bromine is one of those totally opaque chemical markets that retail investors, rarely understand. Why is the global market suddenly willing to pay a massive premium for bromine in early 2026?
Well, to understand the price spike, you really have to understand the industrial applications of bromine, which ICL basically extracts as a secondary benefit from their Dead Sea operations, by the way.
Oh, really? That's efficient.
Very. Now, the primary demand driver for bromine right now is flame retardants. But it's not just like general building construction.
Right, because interest rates are high, so construction is pretty soft.
Exactly. Management specifically highlighted that while the broader building and construction market was soft, they saw this massive unexpected surge in demand from the electronics end market.
Electronics. So we're talking about printed circuit boards, servers, the physical hardware that runs data centers.
You hit the nail on the head. With the explosive build-out of AI infrastructure right now and the constant upgrading of server farms, you have these incredibly dense computing setups.
Drawing massive power.
Exactly. They draw massive power and generate extreme heat. So the plastics and resins housing all these components, they absolutely require high-grade brominated flame retardants just to meet basic safety standards.
Wow.
Yeah, so ICL is perfectly positioned to capture that specialized tech hardware demand, which, by the way, operates completely independently of the agricultural cycle.
That is just a brilliant natural hedge. If farmers are struggling, well, maybe tech companies are booming, so you're covered.
Exactly.
But there was a wrinkle in the industrial products segment that caught my attention. They also use bromine to produce clear brine fluids, right?
Yes, they do.
And these are like dense chemical fluids, zinc bromide, I think, that the oil and gas industry pumps down into wells to maintain pressure during drilling operations. But the transcript noted a decrease in sales for those specific fluids.
They did see a drop-off, yeah. But they explicitly stated this was due to a timing shift. Yeah. Specifically in offshore drilling activity in the Gulf of Mexico.
Ah, okay.
Yeah, the major drilling projects just got pushed from the first quarter into the second quarter.
Wait, which means they achieve these massive record-breaking revenue numbers while one of their highly profitable industrial product lines was essentially on pause.
Yep.
That delayed revenue from the Gulf of Mexico is going to get booked in Q2. That honestly makes the Q1 beat significantly more impressive because they were technically fighting with one hand tied behind their back in the oil and gas sector.
It really speaks to the diversity of their revenue streams. And, sometimes those streams benefit from pure luck, too.
What do you mean?
Well, beyond potash and bromine, ICL produces specialty minerals, specifically magnesium and de-icing salt.
Oh, salt for the roads.
Right. And we had some severe winter weather patterns across North America late last year that extended into early 2026. That just supercharged their salt sales. You cannot build a 5-year financial model that accounts for a perfectly timed blizzard, right? But when it happens, a company with pre-positioned inventory simply drops that windfall straight to the bottom line.
Okay, so we've mapped out the tailwinds here. We have the machinery optimization at the Dead Sea pushing potash volumes up, the AI-driven tech boom lifting bromine prices, and Mother Nature delivering a very profitable winter.
A solid combination.
Definitely. But now we really have to flip the script, because the headwinds dragging against this company were brutal. If those tailwinds hadn't been so strong, this earnings report would have been a total bloodbath.
Yeah, the cost side of the equation was ugly.
Let's talk about sulfur.
Ah, sulfur.
Yeah.
The dark cloud hanging over their entire phosphate solutions division, and frankly, over the entire global fertilizer complex right now.
Then why is sulfur so critical?
To understand why it matters, you have to understand the basic chemistry of how ICL makes money in phosphates. They mine raw phosphate rock, sure, but you can't just throw raw rock onto a cornfield.
Right, it doesn't do anything.
No. It has to be processed into a water-soluble fertilizer, like DAP or MAP. And to do that, you need massive quantities of sulfuric acid.
And to make sulfuric acid.
You need elemental sulfur.
Right. And the cost of that sulfur didn't just inch upward. According to the CEO, Elad Aronson, the price of sulfur skyrocketed by over 100% during the quarter.
It literally doubled.
It doubled. How does a global commodity just double in price in 90 days?
Well, it all comes down to where sulfur originates and how it physically moves around the world. Sulfur is largely a byproduct of the oil and gas industry. It's extracted during the refining of sour crude oil and the processing of natural gas.
Okay.
And Elad dropped a really terrifying statistic during the Q&A segment. He noted that 50% of the world's traded sulfur comes out of the Gulf states and the Middle East.
Oh, wow. Half the global supply is sitting in one of the most geopolitically volatile regions on the planet.
Precisely. So when you have escalating tensions in the Middle East, drone attacks, and specifically the disruption of maritime shipping through the Red Sea and the Strait of Hormuz, the cost of moving a physical commodity like sulfur just explodes.
Because no one wants to sail through there.
Exactly. It's not necessarily that there is a global shortage of actual sulfur molecules. It's that the risk premium and the insurance cost to port out sulfur on a Panamax ship and sail it out of the Persian Gulf have become absolutely astronomical.
And because ICL's phosphate processing operations rely so heavily on imported sulfur, they catch the full force of that price shock.
Right on the chin.
The CEO actually admitted that this took a massive chunk out of the EBITDA for their phosphate division. It brought it down to $131 million. They had to absorb a 100% cost increase on a fundamental raw material.
It's a huge hit.
But the pain wasn't just in the price of the material itself, right? It was also in the currency they used to operate.
Which brings us to the Israeli shekel. Yes. And this is a macroeconomic dynamic that often confuses retail investors who only look at dollar-denominated financial statements. Currency friction is not just accounting noise. It is a very real transfer of wealth away from shareholders.
Okay, let's break down the exact mechanics of this friction for the listener, because ICL trades on the New York Stock Exchange. They report all their earnings in US dollars. Wall Street models their cash flow in dollars.
Right.
But they're headquartered in Tel Aviv. And those massive, highly optimized evaporation ponds we just talked about, they are located at the Dead Sea in Israel.
Which means a massive portion of their operational expenditure, paying the salaries of their engineers, settling local utility bills, paying local taxes and royalties to the Israeli government, all of that must be executed in the local currency, the Israeli shekel.
Okay, that makes sense.
Now, what happened in the first quarter of 2026 was a bit of a macroeconomic anomaly, because despite being in a state of conflict, the shekel actually strengthened significantly against the US dollar.
Wait, why would a local currency strengthen during a regional war? I mean, you would normally expect capital to flee, driving the currency into the ground.
You would, But it's a combination of aggressive intervention by the Bank of Israel, high domestic interest rates that attract yield-seeking capital, and the underlying strength of Israel's high-tech export sector.
Oh, because they're constantly bringing foreign currency into the country and converting it to shekels.
Exactly. The result is a really robust local currency. But for a dollar reporting company like ICL, a strong shekel is devastating.
Let me use an analogy here to make this tangible for you guys listening. Imagine you are trying to run a marathon and your pace is excellent. But every mile, someone slowly adds a rock to your backpack.
That's a good way to put it.
Right. Like you are still running, your engine is working just as hard, but your forward velocity drops and it takes way more energy to cover the exact same distance. The strong shekel is those rocks. If ICL earns $1 million selling potash to Brazil, but the shekel has strengthened by 10%, that $1 million buys them 10% fewer shekels when they repatriate that cash to pay their factory workers in Israel.
Yeah. Their local operating costs effectively increased by 10% purely due to exchange rate math, without a single local supplier actually raising a price.
And Aviram Lahav, the CFO, put an exact price tag on those rocks in the backpack. He stated on the call that this currency friction cost ICL over $20 million in the quarter.
$20 million?
Yeah, $20 million of operating profit effectively vanished into the ether of the foreign exchange market.
It's painful.
But wait, a sophisticated multinational corporation like ICL surely engages in currency hedging, right? I mean, they don't just ride the spot rate every day. Don't they use forward contracts and options to lock in exchange rates and protect those margins?
Oh, they absolutely do. But hedging is not a magic shield. It is more like a shock absorber.
Okay, how so?
Well, a hedge will protect you from a sudden, violent swing in a currency over, say, a 3 to 6 month window.
Right.
But if a currency structurally appreciates and stays strong over multiple quarters, which is what the shekel's been doing, those hedges eventually expire.
Ah, and then what?
When ICL goes to roll those hedges forward and buy new contracts, they are forced to buy them at the new, less favorable market rate. You can delay the pain of a strong local currency, but you cannot permanently void it if your costs are local and your revenues are global.
Okay, so they are fighting a 100% spike in sulfur costs driven by Red Sea shipping disruptions, and D, a $20 million invisible tax from a stubbornly strong shekel.
Yeah, quite the combo.
So how did they possibly maintain enough pricing power to overcome all of that and still post double-digit growth? This actually brings us to the most critical geopolitical insight from the entire earnings call.
The China factor.
Yes. The dynamic that explains why ICL's customers are willing to pay almost any price they ask right now. We really have to talk about the China vacuum.
This is the crux of the global agricultural market in 2026. During the Q&A session, an analyst actually pressed the management team on the sustainability of their phosphate pricing. They were basically asking, if sulfur is so expensive, why aren't margins completely collapsing?
And the CEO's answer pointed directly to Beijing.
It did.
You know, to understand the magnitude of this, you have to understand a concept common in the financial sector. A run on the bank.
Good analogy.
Imagine there's a town with 3 major banks holding all the gold. Suddenly, the biggest bank in town locks its doors, puts up metal shutters, and announces, "We are no longer letting any gold leave this building."
Total panic.
Exactly. Panic. Everyone rushes to the other 2 banks, desperate to secure whatever gold is left. And those remaining banks can suddenly charge exorbitant fees because the supply just evaporated overnight.
Right.
That is exactly what China is doing to the global fertilizer market.
It is a perfect structural analogy.
Yeah.
Because China is a literal titan in the global phosphate market.
Yeah.
Historically, they have been one of the largest exporters of phosphate fertilizers. They supply millions of tons to India, South America, Southeast Asia.
We're the biggest bank in town.
Exactly. But, as ICL management highlighted, China has reportedly instituted a hard block on phosphate exports for the remainder of 2026. They have essentially shuttered that bank.
But why? I mean, is this an aggressive trade war tactic? Are they actively trying to squeeze the West?
No, actually, it is much more pragmatic than that. And frankly, it's more deeply rooted in domestic survival. It all comes down to food security and internal inflation control.
How so?
Well, the Chinese Communist Party's primary mandate is domestic stability. To maintain stability, you need affordable food, particularly staple proteins like pork and poultry.
Right.
To keep pork prices low, you need massive amounts of cheap animal feed. which means you need massive domestic yields of corn and soybeans. And to get those yields, Chinese farmers absolutely need cheap, abundant fertilizer.
So as global prices for fertilizers started to rise because of the Middle East conflicts and the sulfur spikes we mentioned, the Chinese government basically looked at the math.
They did.
They realized that if their domestic producers exported all their phosphate to capture those high global prices, Chinese farmers would be left with a domestic shortage.
Exactly. The cost of fertilizer inside China would skyrocket, crop yields would fall, the price of feed would explode, and ultimately, the price of pork in a Beijing supermarket would become politically untenable.
Wow.
Yeah, so the National Development and Reform Commission in China essentially dictates export quotas. By blocking exports entirely for 2026, they are artificially flooding their own domestic market with phosphate to keep their own farmers afloat, while simultaneously starving the rest of the world.
Which creates a massive gaping vacuum in global supply. The CEO explicitly stated that before the recent sulfur spikes, the delay in Chinese exports was already the #1 factor keeping global phosphate prices elevated.
Right.
Now, with an outright ban for the rest of the year, the supply bottleneck is absolute.
This is the source of ICL's phenomenal pricing power. When India or Brazil needs phosphate to plant their next crop and the Chinese spigot is completely turned off, they have to turn to suppliers like ICL.
They have no choice.
The CEO phrased it bluntly on the call. He said, "There will be demand out there. Somebody has to fulfill it." ICL is one of the few global players with the operational capacity to actually fulfill it.
They have a captive audience. And a captive audience pays the asking price.
They absolutely do.
I mean, it is a phenomenal position to be in if you are an ICL shareholder. You are the premium supplier in a market where the biggest competitor just voluntarily benched themselves.
It's a gold mine.
But this brings us to the darkest part of this economic equation. And honestly, the biggest risk hanging over this stock right now, we need to talk about the concept of demand destruction.
Yes. Yeah. The breaking point.
Right. Because while ICL can force these high prices onto the market today, they are ultimately selling to a customer base that is mathematically breaking down. They are selling to the farmer.
And this is where the macroeconomic rubber really meets the road. You see, Wall Street often treats demand as this theoretical line on a chart that stretches to infinity.
Right. The line goes up.
Exactly. But in the physical economy, demand has a breaking point. You can only squeeze a buyer so hard before they physically cannot afford the transaction.
And the CFO, Aviram Lahav, spent a significant amount of time detailing the macroeconomic environment for that end user. And the picture he painted of the agricultural sector was incredibly grim.
It was not pretty.
We have to look at the exact math a farmer is facing in 2026. Lahav noted that while crop prices soar, the money the farmer makes from selling corn, wheat, or soybeans, they ticked up slightly in the first quarter, but they are still heavily depressed compared to historical averages.
Yeah.
But the input costs, the fertilizer, the diesel, the equipment, those are soaring.
He specifically referenced the Argus Index, which tracks the affordability of nutrients for farmers.
What did it say?
According to their data, nutrient affordability fell to 0.57 points in March. That is the lowest level of affordability in nearly 5 years, dating all the way back to late 2021.
Oh, wow.
Yeah. Lahav stated that U.S. farmers are currently facing one of the widest gaps in a decade between the cost of producing food and the revenue earned from actually selling it.
Let's make this math visceral, because I think this is the aha moment for understanding the risk in this sector. Let's say you are running a 2,000-acre corn farm in Iowa.
Okay, I'm with you.
5 years ago, maybe it took 300 bushels of your harvested corn to generate enough cash to buy a single ton of DIP fertilizer.
Right.
Today, because your corn price is basically stagnant and the fertilizer price has doubled due to sulfur spikes and Chinese hoarding, it might take 600 or 700 bushels of corn to buy that exact same ton of fertilizer. Your purchasing power has been literally cut in half.
That's a brutal reality check.
And it gets worse when you factor in the cost of capital.
Oh, absolutely. That is a critical point. Because farmers operate heavily on credit. They take out massive operating loans in the spring to buy seed and fertilizer, and they pay those loans back after the autumn harvest.
Right.
With interest rates remaining elevated in 2026, the cost of simply borrowing the money to buy ICL's expensive phosphate has skyrocketed.
So if I'm that farmer in Iowa looking at my spreadsheet in the spring, what do? The math tells me that if I buy this fertilizer, I am mathematically guaranteed to lose money on every single acre I plant. At what point do I just throw my hands up and say, I am not buying it. I will mine the soil this year?
Mining the soil is the exact right industry term for it. It means the farmer decides to skip the fertilizer application entirely and just rely on the residual nutrients left in the dirt from previous years.
Which means the crop yield will be lower.
Yes, the yield suffers, but they avoid that massive upfront cash outlay. When millions of farmers make that calculation simultaneously, you get demand destruction. The demand doesn't just dip, it falls off a literal cliff.
And this isn't theoretical. The CFO noted that a recent survey showed a staggering 46% of U.S. farmers cited high input costs as their single biggest concern.
26%.
Yeah. And another 14% cited input availability. That is 60% of the market waving a massive red flag. The CEO acknowledged this directly. He admitted that because they are forced to increase phosphate prices to cover their sulfur cost, he fully expects end market demand to be lower than usual for the rest of the year.
Yeah, and if that demand destruction materializes violently, ICL's pricing power becomes totally meaningless.
Exactly.
You can price your potash at $400 a ton, but if the farmers refuse to buy it, your volume drops to zero, your warehouses fill up, and your cash flow completely evaporates. It's a very high-stakes game of chicken between global chemical suppliers and the local farmer right now.
Which makes our next segment utterly fascinating. We've established the tailwinds, the brutal sulfur and currency headwinds, the China vacuum, and the looming threat of massive demand destruction.
The full picture.
Right. Given this incredibly precarious tightrope, how does the executive team at ICL view the rest of the year? We look to management guidance because if farmer affordability is at a 5-year low, the logical assumption is that ICL is panicking behind closed doors.
You would think so.
You would expect them to lower expectations, conserve cash, and prepare for the worst. But looking at their forward guidance, they're doing the exact opposite. They are doubling down.
They really are. They didn't just maintain their previous projections, they actively raised their 2026 full-year EBITDA guidance by $100 million.
$100 million.
Yeah. They are now projecting to land somewhere between $1.5 billion and $1.7 billion in EBITDA for the year.
I mean, is this arrogance or is it justified confidence? Raising guidance by $100 million in an environment where your raw material cost just doubled requires a massive amount of conviction.
It signals profound confidence in their structural advantages, and honestly, their read on the macro environment. What this guidance tells the market is that management has modeled out the demand destruction risk, they have modeled out the sulfur costs, and they firmly believe the China vacuum will create enough desperate buyers globally to outrun the farmers who drop out of the market.
So they think the panic buying will outweigh the people quitting.
Exactly. They are betting that the elevated prices for their key products will simply overpower the rising costs of raw materials and the mid-single-digit increase in ocean freight rates they're also absorbing right now.
They also laid out specific operational targets to back this up. They projected potash sales volumes to hit between 4.5 million and 4.7 million metric tons for the full year.
Which is a very healthy number.
Yeah, that tells us they expect those structural improvements at the Dead Sea and in Spain to consistently deliver high throughput month after month. They are committing to a high volume output. But there was a moment during the Q&A segment with analysts that I really want your take on, because it deals with how they plan to protect these margins if their macro bet is wrong.
Oh, you're talking about the exchange with the Jefferies analysts.
Yes. An analyst from Jefferies asked a very pointed structural question. He wanted to know how ICL plans to defend its margins over the next 3 to 5 years, specifically what internal levers they could pull to generate fixed cost savings independent of market prices.
Right.
And the CEO, Alad Aharonson, gave a very interesting response. He teased that they were working on, quote, structural productivity projects.
I noticed that.
But when pressed for details, he completely stonewalled. He refused to give any specific targets, timelines, or financial metrics. He basically said it is not a good time yet to go into really deep down details and claimed they would only talk about it when the proof is in the pudding.
And how did you read that?
Well, my immediate reaction is skepticism. When a CEO waves his hands and promises vague structural productivity, but refuses to provide a spreadsheet showing where the savings are coming from, it usually means it's corporate speak.
You think they're bluffing?
It sounds like a placeholder answer to keep analysts from downgrading the stock while the management team scrambles to actually figure it out.
You know, it's very easy to be cynical, and in many cases with corporate earnings, you would be right. But I actually interpret Aaronson's reluctance through a completely different lens.
Really? Tell me.
In the context of a highly volatile commodity market, I view that opacity as a sign of incredibly disciplined leadership and strong corporate governance.
Explain that, because Wall Street hates opacity. They want the 3-year capital expenditure plan mapped out to the decimal point.
Wall Street does want that, yes. But Wall Street is also ruthlessly unforgiving when a company overpromises and underdelivers. If Aronson goes on the record and promises a $200 million reduction in fixed costs by 2028 based on streamlining a specific supply chain, and then a drone strike in the Red Sea completely alters global shipping routes for the next 2 years, that plan is dead.
And the stock tanks.
Exactly. The stock gets punished for missing a target that was entirely outside of management's control.
So by keeping their cards close to their chest, they're preserving their optionality.
Exactly. It's an acknowledgement of reality.
Yeah.
They operate in a world where 50% of their most vital raw material, sulfur, comes from a geopolitical powder keg that, in the CEO's own words, can basically change overnight.
Right.
You do not make rigid, multi-year, highly publicized, cost-saving commitments in that environment. You stay nimble. You focus on agility over predictability. By saying, we will show you the savings when they actually hit the bank account, they are refusing to play Wall Street's game of theoretical forecasting. It's a show-don't-tell philosophy that prevents them from backing themselves into a corner.
Okay, I see your point. It's the difference between managing the business for the health of the balance sheet versus managing the business to appease a quarterly analyst model.
Precisely.
Okay, we have unpacked the mechanics of the earnings beat, the geographical moats, the geopolitical supply shocks, the macroeconomic squeeze on the farmer, and a surprisingly aggressive forward guidance. It is time to distill all of these competing forces into the ultimate bottom line for the retail investor.
The verdict.
This is the actionable takeaway. What is our official stance on ICL Group coming out of Q1 2026?
Synthesizing the immense operational resilience against the severe macro risks, we view this quarter as a definitive yet cautious bullish signal.
Cautious bullish. Okay, let's build the thesis, starting with the bull case. Why does this stock deserve a place in our portfolio right now?
The foundational argument for the bull case is that ICL is demonstrating an extraordinary ability to print cash in an environment that is actively trying to destroy it. They aren't just surviving. They are exploiting market inefficiencies, like the China vacuum, to generate nearly $200 million in operating cash flow in a single quarter. But the most compelling aspect for a retail investor isn't just that they make the money, it's what they actually do with it.
Ah, you're talking about the dividend policy.
Yes. ICL maintains a very strict, transparent corporate policy of paying out 50% of their adjusted net income directly to shareholders as a dividend.
Let's talk about the mechanics of that specific policy, because it's actually very different from how a lot of blue chip U.S. companies operate. Most traditional dividend stocks commit to a fixed dollar amount, say 50 cents a share, and they try to slowly grow that amount every single year, regardless of how the underlying business performs.
Yeah, they get trapped by it.
Right. They will even take on debt to fund the dividend just to keep their streak alive. ICL's policy is variable.
And that variability is a massive strength in a commodity business. By pegging the payout strictly to 50% of adjusted net income, they protect the balance sheet.
Makes sense.
When times are booming, like they are right now, the shareholder gets a massive windfall. In this quarter alone, that 50% payout translated to a total dividend distribution of $69 million.
Wow.
Looking at the trailing 12 months, that results in a highly attractive dividend yield of 3.7%. But if the market crashes and net income falls, the dividend automatically shrinks, ensuring the company never accidentally over-leverages itself just to pay investors.
It aligns the shareholder directly with the reality of the business. You get 3.7% today, which is a fantastic yield in an inflationary environment, but you have to accept that it will fluctuate.
Right.
And their balance sheet backs up this discipline, too. The CFO highlighted that they have $1.5 billion in available liquidity resources. Their net debt to adjusted EBITDA ratio is sitting at a very stable 1.5 times, which means they are nowhere near being over-leveraged.
No, they're in a great spot financially.
Furthermore, both Fitch and S&P recently reaffirmed their BBB investment-grade bond rating. So the financial foundation is rock solid. So they have pricing power, geographical moats at the Dead Sea, strong cash flow, and a 3.7% yield. That is a formidable bull case. But you added the word cautious.
I did.
What is the bear risk that could unravel this entirely?
The bear risk is that the laws of economic gravity eventually reassert themselves and ICL is caught holding the bag. If you're considering buying this stock, you must maniacally monitor the two variables that are completely outside of management's control: global sulfur prices and the Argus Affordability Index for farmers.
The sulfur risk is straightforward. If the conflict in the Middle East escalates further, shutting down the Strait of Hormuz entirely, the cost to import sulfur doesn't just double, it could quadruple.
Exactly.
At that point, the cost to produce phosphate fertilizer exceeds any price the market is willing to bear, and ICL's margins evaporate instantly.
And the second risk, the demand destruction, is the silent killer. If you track the agricultural data later this year and see that U.S. and Brazilian farmers are actually executing on their threats to mine the soil and skip fertilizer applications, the volume shock to ICL will be violent.
Because they just won't buy.
If farmers simply refuse to buy, ICL will be sitting on millions of tons of incredibly expensive inventory that they cannot move. The revenue drops, the EBITDA collapses, and because of that variable dividend policy we just praised, your dividend payout plummets right in tandem.
So let's make it actionable. What should the listener do with this information today?
If you are currently holding ICL stock in your portfolio, keep holding. Do not panic sell into the geopolitical noise. The company just raised its guidance, their pricing power is clearly intact, and that 3.7% dividend yield is paying you handsomely to wait out the macroeconomic volatility.
You are being adequately compensated for the risk.
Exactly. You are being paid to hold the asset.
And if you don't own it, but you are looking to deploy capital and buy in,
ICL is a highly effective defensive play against inflation because they deal in hard, essential commodities that inherently rise in price when inflation runs hot. But, and this is a critical caveat, do not treat this as a passive set it and forget it investment.
Right, it's not an index fund.
If you buy ICL today, you are making a very specific, active macroeconomic bet.
You are betting that the global supply chain remains somewhat broken.
Exactly. You are betting that China prioritizes its own food security and keeps its exports blocked. You are betting that sulfur prices stabilize or fall. And you are betting that global crop prices rise just enough to keep the farmer off life support so they can afford one more round of expensive fertilizer.
It's a tightrope.
You are buying a company that currently profits immensely from the world being a little bit messy. But if the world suddenly gets too messy or completely resolves its issues, the underlying math changes rapidly. It requires your active attention.
It is the ultimate premium supplier in a highly constrained world. Well, that wraps up our deep dive into the mechanics and the madness of ICL Group's Q1 2026 earnings. We want to thank you, the listener, for spending the time to truly understand the forces moving these markets.
Thanks for tuning in.
As always, a quick reminder, while we obsess over breaking down the data, the chemical supply chains, and the geopolitical drama, we are not your personal financial advisors. You must always align these insights with your own macroeconomic research and your personal risk tolerance before making any moves with your capital.
The commodities market moves fast, and as we've detailed today, a single policy decision in Beijing or a shipping disruption in the Red Sea can alter the fundamental value of a company overnight.
Absolutely. Before we sign off, I want to leave you with a final thought to mull over, something that wasn't explicitly discussed on the earnings call, but builds directly on the reality of the geopolitical bottlenecks we just unpacked today.
Let's hear it.
Think about the broader trajectory of the next 10 years. Global food security. The literal ability to keep billions of human beings alive rests entirely on the delicate, continuous supply of just a few key nutrients: potash, phosphate, and nitrogen. We just saw how easily the scales tip when a single player like China decides to hoard its own supply.
It immediately weaponizes the remaining supply.
Exactly. With ongoing conflicts threatening the global flow of sulfur and energy, and nations increasingly prioritizing domestic survival over free trade, are specialty chemical and mining companies like ICL undergoing a fundamental transformation.
That's a great question.
Are they evolving from being viewed as somewhat boring, cyclical dividend stocks into the ultimate geopolitical trump cards of the next decade? When a single corporation controls the very geographic moats and chemical ingredients required to grow food in a volatile, fractured world, what is that leverage actually worth?
A whole lot more than it used to be.
Right. And more importantly, how long until global superpowers decide that relying on the open market for these vital nutrients is a vulnerability they can no longer afford? It's something to think about as you watch these supply chains tighten. Until next time, keep digging into the data